it to your last video. Congratulations. It's your last video of Accounting 102. And in this video, we're going to take a look at intangible assets and goodwill. So for these ones, we've discussed a little bit earlier what intangible assets are. And these are assets that have no physical form, or their benefit doesn't come from their actual physical form. It comes from a special right that they convey. So the right of ownership that these assets actually give. So for example, patents, trademarks, copyright, franchises, these are intangible assets. So a patent, for example, if you come up with an invention, you can apply for a patent, and that gives you the exclusive right to produce and sell that item. So the benefit isn't from that piece of paper that says, yes, you have a patent. The benefit is this special right that allows you to be the only one that can sell that invention. So that is where the benefit comes from. Now, intangible assets, they often have a limited life. And if that's the case, they get amortized in the same way that you would amortize PP&E. Except for when we look at their useful life, it needs to be the lesser of these two things. So either the asset's legal life or the estimated useful life, which could be less than that legal life. So for example, for these, the patent that we talked about, it has a 20-year legal life. But say it's some invention with technology, we know that there's new technology coming very often. So even though the legal life is 20 years, maybe the useful life is only 5 years. So if that's the case, that's what you would amortize it over. So whichever is less. Now there are some intangible assets that have an indefinite life. So if that's the case, you think it's going to be this benefit forever, then these are not amortized. Sort of like land that has that indefinite life. We don't amortize it. So the method to calculate your amortization would be the same way as PP&E. So we're not going to go into an example of that. But in this case, when you're recording the amortization expense, you can actually record it directly against the intangible asset account. So there's no accumulated amortization for an intangible. You would just debit amortization expense, credit patent, or credit the copyright. So you can do it directly against that intangible asset account. Now the last thing we're going to talk about is goodwill. So goodwill is a special kind of intangible. And the way that this comes up is only from purchasing another business. So that is the only way you would get goodwill. Only from purchasing another business. And it represents this future economic benefit arising from you purchasing that business. And the way that it's calculated is you take the excess of the cost, so what you actually pay when you purchase the business, over the fair market value of the net identifiable assets. So this is assets minus liabilities. And it is this extra value that you're buying from the business. So for this, if we just think about an example, if you buy some sort of other business, when you're buying the business, you're taking over everything. So you're buying all of the assets they have, but you also become responsible for any liabilities. So whatever that net identifiable assets is, that's what you're buying. And you set this up in a journal entry at that fair market value. So what is it actually worth? But you often see that people pay extra above that value. So for that, or the reason for that, is that you tend to be buying the reputation of the business. if they have a loyal customer base, that's a benefit to you. So yes, you're getting the assets less the liabilities, but you're getting that intangible benefit of the reputation that already exists rather than just starting up a brand new business. So that is why people would pay more, and that is what Goodwill is. Goodwill is not amortized because it is just an indefinite life. You think that that's always going to be useful, but you do this annual test to see if there's impairment. So we're not going to go into detail on that, just something to note. Okay, so that's the idea of Goodwill. We'll do a quick practice question on this so you can see how this works. So S10-8 says, media-related companies have little in the way of property, plant, and equipment. Instead, their main asset is goodwill. So when one media company buys another, goodwill is often the most costly asset required. So that's just some extra information. So we're assuming that Media Watch paid $800,000 on March 22nd to acquire the Thrifty Dime, a weekly advertising paper. At the time of the acquisition, the Thrifty Dime's balance sheet reported total assets of $1.3 million and liabilities of $600,000. The fair market value of Thrifty Dime's assets was $1.2 million. So it first says, how much goodwill did they purchase as part of the acquisition? So we say it's the cost over the fair market value of the net identifiable assets. So assets minus liabilities. So in this case, we're buying some assets and we need to look at the fair market value of these. And in this question, that was $1.2 million. So on their books, on the balance sheet, it was at 1.3, but there was something there that actually didn't have that value. So maybe they had equipment that was valued less than the book value. So we use the fair market value, and then we also need to subtract the liabilities. And with liabilities, fair market value is just what it is for the most part, because if you have AP, that's how much you pay. That's the fair market value. So here, our liabilities were at $600,000. So we use this and we calculate the net assets, net identifiable assets, and that's $600,000. So that's the overall value of the identifiable assets that we're buying. So of the things that we can see, that's what we're getting, the net. But we actually pay $8,000. So the purchase price it said there is $800,000, and we subtract this $600,000, which is our net identifiable assets. And that's saying, well, we paid $200,000 extra. This is what our goodwill is. So we were willing to pay that $200,000 extra to get these bonuses or the extra benefit of buying this advertising company. So perhaps the advertising company has these customers that run ads there and they're in contract for 2 years. So that has value because it guarantees this new purchaser to have those amounts run. They're going to have those ads, they're going to make that revenue. So that is that goodwill that you see there. Part B, or number 2, says to journalize the acquisition of Thrifty Dime. So in this case, we don't have the details of what these assets are, but if you did, you would set them up in detail. Here, we just need to do a summary. So we would debit whatever the accounts were, and this would be all of our assets. So if we bought cash and we bought accounts receivable, and maybe we had some sort of computers, all of those would be listed separately, and we would book them at the fair market value. So 1.2 million. We would also need to set up all of those liabilities. So whatever the accounts were, that's what we would book. So we likely bought some accounts payable, maybe a bank loan, things like that. So we would credit each of those accounts for their amount, and the total is $600,000. We know that we paid cash of that $800,000. That was our purchase price. So we're crediting that. And our journal entry doesn't balance. And the reason for that is because we have that Goodwill that we purchased. So we're at 1.4 million in credits, and we need to debit our Goodwill account for the 200,000 that we calculated. And after that, we now balance, and we've recorded everything. So that's it. Essentially, you record your assets that you're getting at the fair market value. You record your liabilities at their value. Record the cash that you paid, and Goodwill. I should really move it down a little bit. My lines don't line up so much there. Goodwill is really that plug of why did you pay extra, and how do you record that in your books. So it only comes up when you purchase a business and you're buying those net assets. Okay, so that's Goodwill. The last thing I want to show you here is just to say that IFRS and ASPE have very different treatment for PP&E. So we're not getting into the details of that. You're not responsible to know the details of this. Just know that there is that difference. IFRS is quite a bit more complicated. So we will not get into it in this course, but if you take future accounting courses, you would see that there. Okay, thank you guys again. I appreciate that you've watched all these videos, and hope you enjoy the rest of the semester, and good luck next semester. And of course, I'll see you in your live classes and later as well. But last video, so congrats on making it this far.